The Algebra of Wealth by Scott Galloway. To achieve financial independence, you need to reach the number, which is calculated by multiplying your annual expenses by 25. Let's say you need $80,000 per year. Your number would be $2 million if we assume a 4% return on your investments. Since 4% of $2 million is $80,000, reaching this number would make you financially independent. This book provides the formula for achieving this number and getting a sufficient return, so you no longer need to work. This is the formula for wealth. The first variable we will discuss is stoicism. For most of his life, Galloway thought he was exceptional. He earned a lot but didn't save. He believed he would be rich whenever he wanted. However, the dot-com crash, a divorce, and the 2008 financial crisis showed him that success wasn't guaranteed. When his first son was born at 42, he felt ashamed realizing he had failed. His problem wasn't a lack of financial knowledge. He had an MBA. The real issue was a lack of self-control. Achieving economic security isn't just about knowing what to do. It's about consistent behavior over time. Saving is difficult because capitalism taps into our natural cravings. Have you ever heard the phrase keeping up with the Joneses? Here's where it comes from. A family trying to keep up with their wealthy neighbors, the Joneses. The family couldn't actually see the Joneses, but they knew about the luxury car in their driveway and the stylish clothes they wore. So, every time the Joneses got something new, the family felt the pressure to buy the same or better, even if they couldn't afford it. All to look like they were just as successful. This story still holds true today. Many people spend money on things not because they need them, but because they want to match the lifestyle they see around them. Social media can make this even worse, as we see constant glimpses of others' luxury vacations, new gadgets, or designer clothes. In the end, keeping up with the Joneses can lead us to financial stress and even debt. The Stoics identify a powerful method that helps us resist modern temptations, making it a habit. In 2016, Galloway started a blog for his business, even though he didn't consider himself a writer or someone who could stick to a regular schedule. The first post was easy, but over time, writing weekly became a challenge. However, as he continued, it became a habit, and he found satisfaction in the process and feedback from readers. Eventually, writing became part of his identity. Now the blog reaches over 500,000 people. Consistent action turns habits into identity. The next variable is focus. The first step in obtaining financial freedom is to choose a career that helps us save money. The first question that comes to mind is whether we should focus on our talent or our passion. Successful people often say, follow your passion, but Galloway suggests the opposite, follow your talent. Let's consider James and you. Both are born in the US, and James has a passion for acting. However, James is not as talented as other national actors. No matter how hard he tries, it's very unlikely for him to succeed in it. On the other hand, you have a talent that matches the level of national stars, even though you don't have a passion for acting. If you try acting, you will likely be successful, and as you become successful, you'll start to develop a passion for it. Meanwhile, James has a strong talent for basketball. He could become the next LeBron James, and once he becomes successful in basketball, he could then pursue acting as a passion. People who tell you to follow your passion are often already rich. Instead, focus on something you have a talent for and put in the hard work to master it. Over time, as you improve and see the rewards, like financial success, you will become passionate about it. Passion doesn't create mastery, mastery creates passion. Steve Jobs, often cited as an example, didn't follow his passions like meditation or calligraphy. Instead, he found his talent in marketing and became successful. People often misunderstand the word talent. Talent is not just about sports or playing an instrument. Unless you are exceptional in these areas, it's better to keep them as hobbies. Talent refers to what comes naturally to you, but is difficult for others. Like some people are good at managing teams, and qualities like hard work and curiosity can also be considered talents, as these skills are highly valuable in careers. Once you find your talent, focus on a career that suits you, avoiding those that do not. Let's discuss some career options, starting with entrepreneurship. Entrepreneurship involves high stress and long hours. Entrepreneurs need strong communication skills, resilience in the face of rejection, and the ability to manage cash flow. Let's take a look at career and education. Low salaries, but the opportunity to write books. Now shifting our focus to different professions. Careers like doctors, lawyers, and engineers require extensive schooling and training, providing stability and decent compensation. However, they often come with long hours, high taxes, and a salary ceiling. Let's explore what it means to be a consultant. Consultants use diverse skills but face challenges in scaling their businesses. The job offers good pay but can be mentally and physically taxing. Moving on, let's talk about careers in media. These are oversaturated and underpaid. Our next profession to consider is finance. Finance offers immense earning potential but comes with high stress. Turning now to the world of real estate. Real estate is one of the best ways to build wealth, offering tax advantages and long-term returns. Investing in properties either for rental or home improvement can be a lucrative career with proper market knowledge. On to our next field, Main Street economy. Skilled trades like electricians, plumbers, and small businesses offer massive potential, often overlooked by those chasing elite careers. The next variable in the formula is time. Time can work for you in the form of compounding or against you in the form of inflation. Compounding is a process where small changes multiply, significantly boosting growth. Consider two people, Mike and you. Mike starts investing at age 45, putting in $5,000 a year with a 10% return. After 20 years, by age 65, his investment grows to $286,000. You, on the other hand, start investing at age 25, with the same $5,000 a year and a 10% return. After 40 years, by age 65, your investment grows to $2,212,000. You have over 7 times more at retirement because you started earlier, leveraging the power of time. Warren Buffett accumulated 99% of his wealth after age 52 due to the power of compounding over time. Inflation, on the other hand, is the evil twin of compounding. For instance, the average U.S. inflation rate over the past century has been about 3%. This means that something that costs $100 today will cost $103 in a year, $134 in 10 years, and $243 in 30 years. Apart from this, our brains make cognitive errors. We often misjudge time, especially when it comes to investing and financial planning. Like if you have a tough meeting tomorrow, it feels worse than if the same meeting is scheduled for next month. This also affects how we think about money. We focus too much on short-term discomfort or losses and forget about the long-term benefits, like letting investments grow over time. Imagine you plant an apple tree. At first, the plant grows slowly and doesn't produce many apples. But as it grows larger, it starts producing a lot more apples each year. Warren Buffett is like someone who planted his tree early. By the time he was 50, his tree had grown large and most of his wealth came later. Just like a tree, investments take time to grow. The real rewards come later if you're patient. The last and most important variable is diversification. Few people achieve wealth solely through income, except for a few like professional athletes. Most people earn income and then convert that income into capital, money that works for them, making them capitalists. To make informed investment decisions, you must understand the principles of a capitalist market economy. You'll grasp these principles even if you're just 13 years old. Let's discuss trading time for money. Humans uniquely exchange time, using money as the medium for this exchange. For instance, a factory worker trades their time for wages, which they then use to purchase goods, effectively buying other people's time. Other important terms are supply and demand. While everyone exchanges time for money, not all time is valued equally. Prices are determined by supply and demand. For instance, a laborer might earn a certain hourly wage, while a soccer player earns much more for the same amount of time because of his unique skills and the high demand for his talent. When supply is limited and demand is high, prices increase, attracting competition. As competition increases, supply grows, and prices drop until they stabilize at a point that balances supply with demand. When the market is inefficient, it opens opportunities for arbitrage, buying something in one market at a low price and selling it in another for a higher price. One must also understand the difference between price and value. Price and value are distinct concepts in investing. Price refers to the amount an asset sells for on the market, while value represents the potential future income the asset can generate, which can vary for different buyers. Value investing involves seeking out assets priced below their intrinsic value and holding them until their prices rise to match that value. For diversification, one must also understand the investment spectrum. People use money as a medium of exchange, and financial markets transform this money into capital, money actively working to generate more money. The investment spectrum explains different ways to turn money into capital. A good investment is an investment in stocks. Stocks are one of the greatest wealth-producing assets. When you own stock, you own a part of a real company. If the company is profitable, the stock price rises, and you earn money. Understanding a company's true business model and how it generates revenue is key to accurate valuation. For instance, while Google is a tech company, its real business is selling advertising. Another important term to understand is funds. A fund is a pool of money collected from many investors to invest in various assets like stocks, bonds, or real estate. An important asset we can have is real estate. Real estate is a premier asset class due to its long-term stability and ability to generate income through rents or development. While individual property values can fluctuate, land typically maintains a stable terminal value. However, real estate comes with challenges, including lower liquidity and costs like property taxes, insurance, and maintenance. Despite these challenges, it remains a solid investment option. Diversification spreads risk across multiple investments, reducing potential losses. We should aim for diversification, as our goal isn't to be the richest, but to achieve financial security.